This is the summary of The Intelligent Investor, written by Benjamin Graham and presented to you by the Investor B. Benjamin Graham is also known as the father of value investing, and he was also the teacher of legendary investor Warren Buffett. Buffett quotes, by far the best book on investing ever written. Here are a few glimpses from his book. Investment versus speculation. Graham clearly defines an investment operation is one which, upon thorough analysis, promises safety of principal and adequate return. Operations not meeting this requirement are speculative. In this modern world, where one can buy a security in a second on a computer or mobile, people have failed to understand the true definition of investment, which is safety of principal and adequate returns. The so called investors of today have unknowingly become speculators. They watch the prices go up and down and get stimulated by the movements. Instead of taking the advantage of price movements, these so called investors follow the markets and get very bad results. Graham suggests that in his experience and observation extending 50 years, he has not known a single person who has consistently or lastingly made money by following the market. He quotes, the fall, dear investor, is not in our stars and not in our stocks, but in ourselves. We have seen much more money made and kept by ordinary people who were temperamentally well suited for investment process than by those who lacked this quality, even though they had an extensive knowledge of finance, accounting, and stock market law. While enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster. Glimpse number 2, the investor and market fluctuations. Ben Graham explains that stocks are not just pieces of paper to trade, but it represents the portion of business. It is just like a partnership in the business, where you are a passive owner of the underlying business. Value of businesses doesn't change day to day, but stock market values for it changes due to different and weird reasons. Every day the stock market will open and quotes its prices. It is upon the individual to either buy more or to sell or just to ignore the price quotes. It is similar to a broker who comes to your house and every day he quotes the value of the house which you bought. Would you be tempted to sell if he quotes the price a few percentage points below your purchase price? Or would you sell if he quotes a few percentage points above your purchase price? The idea of owning a stock is similar, but due to the invention of computers and ticker prices, where selling and buying is so easy, markets have become a sort of casino. Graham compares everyday quotation to the broker who comes every day and quotes the prices of your securities. He has perfectly phrased the name Mr. Market for it. Mr. Market is a psychological maniac. He becomes very excited some days, and on some other days, he becomes very sad. It is then an unemotional investor takes the benefit of it. Glimpse number 3, timing the market. Graham explains that to get the adequate return, it is important to spend time in the market instead of timing the market. Timing is of great psychological importance to a speculator because he wants to make his profit in a hurry. The idea of waiting a year before a stock moves up is repugnant to him, but a waiting period as such is of no consequence to the investor. Timing is of no real value to the investor unless it coincides with pricing because it enables the investor to even buy more. Glimpse number 4. Bull market characteristics. Generally, bull market has a number of well-defined characteristics. Historically high price level. If price is high and enthusiasm is in the market, one should be cautious while investing. High price to earning ratio. This is in comparison to average price to earning ratio of the previous decade. More about price to earning ratio in coming points. Low dividend yields against bonds. Much speculation on margin. Many offerings of new common stock issues of poor quality. Graham suggests if such condition exists, then one should not be invested more than 25% of his capital, and rest of the money should be in bonds or other risk-free assets, which includes US Treasury. Glimpse number 5. Investment in mutual funds. Is there any way by which the investor can assure himself of better than average results by choosing the right fund? If not, how can he avoid choosing funds that will give him worse than average results? Can he make intelligent choices between different types of funds? Graham clarifies that an individual investor who has stayed invested with a mutual fund for a decade has done better compared to investors who without knowledge and attitude entered into stock market. Mutual funds in aggregate inculcated habits of saving and protected people from gambling at least. Although mutual funds have not fared better than averages due to high costs associated with the fund industry, and mutual fund industry itself creates averages. Glimpse number 6. How to go about a stock selection for a defensive investor. How would a defensive investor go about searching for a right investment? As per Graham, one should consider the following points. Adequate size of the enterprises. Graham would filter the companies having not less than $100 million of annual sales for an industrial company and not less than $50 million of total assets for a public utility. A sufficiently strong financial condition. Here he suggests having current assets should be twice as current liabilities, which is also known by the formula as current ratio. That is, current ratio should be 2:1. Earning stability. The company should be profitable most of the time in the last decade. Dividend record. It should have a history of paying dividends. Earnings growth. A minimum increase in per share earning in the past 10 years using 3-year averages. Moderate price to earning ratio. Current price should not be more than 15 times average earnings of the past 3 years. Moderate ratio of price to assets. Price not to be paid more than 1.5 times book value. Glimpse number 7. Things to consider about per share earning or EPS, earning per share. Graham urges not to take a single year's earning seriously. If you pay attention to the short-term earnings, you are probably entering and exiting shares more like a speculator. You need to understand the reason for increase or decrease in earning per share, whether the effect is temporary or it is permanent. He urges to take into account the average earnings of the past 10 years and to pay as minimum price in relation to the average earning for the company, which is also called the PE ratio. The lower the PE ratio of the company, the less the price a defensive investor is paying in relation to its earnings. And literally, he is buying the future of the company for free. If earnings exceeds the Wall Street expectation in coming years, there will be substantial increase in the share price of a company. The formula for price to earning is market capitalization of the company divided by the total earning of the company in that particular year. That is, P is market capitalization and E the earning. Market capitalization is equal to price of the company into number of shares. Glimpse number 7. Margin of safety. Suppose you are driving a truck of weight 100 tons and you appear in front of a bridge which allows you to drive over its maximum weight of 105 tons. What would you do? Would you take the risk of crossing the bridge? Probably not. Graham explains here in the margin of safety that you should only invest if you feel that shares bought by you are at least 40% discount to your calculated intrinsic value. Not following the margin of safety, you may risk losing your capital, like you may risk your life while driving the 100-ton truck over 105-ton bridge. This allows an investor a safety towards his capital, which is the basic criteria of investment. Warren Buffett has always said there are only two rules in investing. Rule number 1, never lose money. And rule number 2, don't forget rule number 1. This is basically the margin of safety concept. Super Investors of Graham and Dodsville by Warren E. Buffett. Buffett has explained by the following example how value investing has worked for the disciples of Ben Graham and how can it be helpful to you. He explains, let's assume 225 million Americans to come up tomorrow to risk $1 on a coin flip. If they call correctly, they win $1 from those who called it wrong. After 10 coin flips, 220,000 people have correctly called it right. After 20 coin flips, we will have 215 people who called it correctly 20 times in a row. If we can find out somehow that most of these coin flippers came from a particular city, from a particular school, then we would start believing that scientifically they had some special training in coin flipping. Similarly, in investment world, super investors who have consistently beaten the market time and time again and have made wealth for themselves or for the clients have come from the school of Graham and Dodsville, which is not surprising. Anyone aspiring to become an investor and wish to do well in investing should read and understand the concepts of Ben Graham and Dodsville, and it could be achieved by understanding the intelligent investor. Let's recap our glimpses. Investment versus speculation. Be an investor, not a speculator. Mr. Market. Mr. Market will come every day to quote its price. Take advantage of him. Better to invest in mutual fund if you are not psychologically oriented to do it by yourself. Understanding how to go on analyzing a stock or a company. Don't lose money, the margin of safety concept. Be followers of Graham and Dodsville and you'll do well in investing like the other super investors. Cheers, guys.